All right, let's talk investing. Does it ever feel like you need a GPS just to figure out where to put your money? Well, today we're looking at a tool that's supposed to be just that, the fund of funds. It sounds super simple, right? But as we're about to find out, that simplicity comes with, well, let's just say there are some hidden tolls on that road.
I mean, seriously, have you ever gone to an investment website and just frozen? There are thousands and thousands of funds to choose from. It's a classic case of choice paralysis, and it is overwhelming. So what if there was a single investment designed to slice right through all of that noise?
Okay, so here's our game plan for today. We'll start with that feeling of being overloaded with choices. Then we'll explain exactly what a fund of funds is. After that, we'll get into the good stuff, the upside, things like diversification and access. But then we got to talk about the downside, specifically those double fees. And finally, we'll help you figure out if it's the right fit for you.
All right, let's get into it. What exactly is this thing? Well, what if you could just buy one single investment and that one thing owned all the other things for you? Imagine a product that does all the heavy lifting, investing in a whole portfolio of other funds on your behalf. That right there is the core promise of a fund of funds.
So officially, a fund of funds, or FOF for short, is a portfolio that's made up of other investment funds. Instead of your money buying individual stocks, the FOF manager takes your cash and buys shares in a whole bunch of other mutual funds or ETFs. I love the analogies here. It's like an investment bento box. One purchase gets you a perfectly curated mix of a little bit of everything. Or, yeah, a curated playlist for your money.
Now, this is where things can get a little confusing, because people often mix up funds of funds with hedge funds. But here's the main difference, and it's a big one. Access. Hedge funds, they're basically exclusive clubs for really wealthy or accredited investors. They're also not as heavily regulated. But funds of funds, they're open to pretty much anybody. In fact, and this is pretty cool, an FOF can actually be your golden ticket into the world of hedge funds, letting you buy a little piece of those exclusive funds you normally wouldn't be able to get near.
Oh, and here's a quick fun fact. If you ever hear the term multi-manager investment, don't let it throw you. It's just a fancier way of saying fund of funds. And when you think about it, it makes perfect sense, right? You're literally investing in the expertise of multiple fund managers all at once.
Okay, so that brings us to the big question. Why would you even do this? What's the upside here? Well, the appeal is pretty powerful. It's about letting a professional do all the shopping for you. You're not just buying a product, you're hiring a whole team of experts to do the hard work.
Let's break down the pros, and there are some really compelling ones. First, you get massive diversification, like instantly. A single FOF can spread your risk across thousands of different assets. Second, as we just touched on, you get access to those exclusive funds that are normally off limits. And finally, let's be honest, the sheer convenience of it all. A professional is handling all the research and selection, which can save you a ton of time and headaches.
But you know how it goes in the investing world. There's no such thing as a free lunch. For all those great benefits, the fund of funds model has one big catch. And you absolutely have to understand this before you even think about jumping in.
And here it is, plain and simple. Double fees. This is, without a doubt, the single biggest drawback. So think about it like this. You pay a management fee to the manager of the fund of funds itself, but then you also pay the management fees for every single one of the underlying funds that it holds. It is literally a fee on top of a fee.
And let me tell you, those layers add up incredibly fast. We're talking a potential total annual fee of 2, maybe even 3%. Now that might not sound like a lot, but let's put it in perspective. On a $10,000 investment, 3% is $300, gone every single year, before you've made a penny in profit. Over decades, that fee drag, as they call it, can cost you an absolute fortune.
And the fees aren't the only thing to watch out for. A couple of other risks to consider. One is illiquidity. Basically, some FOFs aren't traded every day, so you might not be able to sell and get your cash exactly when you need it. And watch out for redundancy. If you own 2 different FOFs, you could unknowingly be paying double fees for the exact same underlying tech fund, for example.
Okay, so we've laid out the good, the bad, and the expensive. Now for the most important part. How do you weigh all this and decide if this trade-off makes sense for your own portfolio?
If you decide to explore this, here's your 3-step research plan. First, when you search online, use the term multi-manager portfolios. Second, and this is non-negotiable, you have to investigate the underlying funds. Know what you're actually buying. And finally, step 3, Read the prospectus like a hawk. You have to understand the total cost before you invest a single dollar.
You know, this quote really captures the entire story. The diversification is real, the professional management is appealing, but it all comes at a price. And as an investor, you have to keep that cost in crystal clear focus to decide if the trade-off is actually worth it for you.
So when it all comes down to it, a fund of funds offers you a trade. You pay a premium for simplicity and professional management. The critical question it leaves you with is this: is the convenience of a curated playlist worth giving up a percentage of your returns every single year? The answer to that will define your investment strategy.